Chameleons and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, contact your registered investment advisor, contact your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
And I'm going to share my screen. If you guys are joining us for the first time, we do this show every morning to try to answer questions you may have about Market Chameleon tools, data, analytics. If you want to come on a show and ask your question live, we provide a link to Zoom. Click on that link. It takes you over to Zoom. Once you're in Zoom, click raise your hand. You don't have to turn on your video camera, but once we let you in, everybody could hear you. You could ask your question live and direct. If you prefer typing in your question, you could type it in on the live chat on YouTube. Will's watching it. He'll read it back to me. While we're waiting for questions to come in, we'll take a few minutes, look at the pre-market report, see what's trading at pre-market hours. We had, I think, a question at the end of the day, and somebody brought up assignment risk. I think it had to do with assignment risk, especially if you're trading spreads.
Yeah, that was Rob. Actually, I missed it in the last minute or so, and I caught it at the end. So
we'll go over that. What are the risks on expiration when you have a certain spread on? We'll take an example of a credit call spread, and what you could do to close out of that risk, mitigate that risk. And what are the different risks involved? So we'll talk about that. If more questions come in, Will let me know, and we'll get to those as well. Okay. So,
all right, we did have another assignment question. When you get to that, I'll give it to you.
Okay. All right. So pre-market report. These are stocks trading in pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Coming down here, I see 63 stocks made our percentage gainers list, 42 on the decliners. So from this perspective, looks like we're setting up for more bullish bias at the opening. If you look at the list, there are stocks in there that are small cap stocks, ETFs, leverage products. Could be a closed-end fund, preferred stock. Pretty much any security that is listed on the major U.S. exchanges, if it's trading in pre-market hours, it hits our thresholds, it can make this list. And we want to try to narrow down the list of stocks to a smaller group to get a little bit more insights. To do that, you could use the filters here above. And this one in ETF, I'm going to show you. When you click on that, you get a list of ETFs to choose from. You can see that there are sector ETFs and there are broad-based ETFs. And when you select one of these ETFs, let's do that. The SPY is the S&P 500 ETF. The list below gets filtered by stocks that are holdings in the SPY. Okay, so here we see that there are 12 stocks in the SPY, which are the S&P 500 constituents, made our percentage gainers list in the pre-market, one on the decliners. So from this perspective, it looks like right now we're setting up for a more bullish bias at the open. So I guess if you had a question come in, Will, and we wanted to discuss the assignment, let me take that question as well, and I'm going to navigate to SPY.
All right. Well, Faiju was asking here for the assignment top. One question: how does the exchange decide who to assign? I guess the stock to? Is it a random process? I guess going through that is
okay. So, well, first let's take a look. First thing, let's just take a look at a call spread, and I'll answer that question as well. So let's say you have a call spread where one leg, let's say credit call spread. So one leg you're selling, right? And I'm going to sell a option that's in the money, 396, and another one that's, let's say, 402. This one's out of the money. And I'm going to load this strategy. So while we're looking at it, these are two different questions. One is you could get there's exercises assignments at expiration, but these options are also American style, and you could get assigned on an option, or you could even exercise an option that you own prior to expiration. Okay, and those are treated differently. Okay, they're the ones that are exercised prior to expiration are treated differently than those that are automatically exercised and assigned at expiration. So we'll discuss the two, because there's a difference, and I have to take one at a time. Okay.
All right.
Let's do the ones that are at expiration first. And when you have a spread like this, you have a call spread, and you could see here, there's a 396 call and a 402 call. You're short the 396, long the 402 call in SPY. And let's say today's expiration, right? We're going to fast forward, and let's say right now, these options are expiring. And if the stock is right here, let's say in between these strikes, right? If they're in between if the stock is in between the strikes, let's say it's $400. Well, what's going to happen is this 402 call becomes worthless, right? And it goes away because it's out of the money. So that no longer is going to exist at expiration. But this 396 call that you're short, that is in the money, and it will get assigned to you, meaning that call that you're short will convert to short stock if you don't close out. So this is your assignment risk, because at expiration, the call spread goes away. You no longer have a call spread. It's either they're going to get converted to stock. They could be both out of the money, which then they both are worthless. Or if they're both in the money, then one will offset the other. So let's say the stock is at 405. Well, if the stock is at 405, they're both in the money, which means that you're going to end up selling the stock at 396 and buying it at 402. That's what it's going to look like, right? Because you're going to exercise your 402, you get assigned on the 396. So in effect, you sold the stock at 396, bought it back at 402, and obviously, so that's a loss because you're negative flipping, but you receive the credit for it, which offsets some of that loss, right? So that's if they're both in the money. If they're both out of the money, let's say the stock is 390, well, then they both expire worthless. They go away, and you just keep the credit that you sold it for. The risk is when it's in between. Okay. Well, there's actually another risk, but let's do the in between first. Okay. So the in between gives you that assignment risk that you're going to end up, in this case, being short the stock. You're going to have to take delivery of the stock, depending on which side you're on. If you're long a bull call spread, you're doing the other side. But on the short, you're taking delivery of the stock. You're going to be short. And if you don't want to be short, then you want to close out of that position, right? Then at that point, you want to just close out of the position on the last day, hopefully for favorable prices, or you're going to buy the stock to offset the short stock you're going to get assigned. So lots of traders, they'll just say, okay, I'm going to get assigned on this stock. I'm just going to buy the stock because maybe the markets are too wide. So if the markets are really wide, you don't want to go and pay a ridiculous price. You might have to just hedge it by buying the stock. Okay. So you don't want to pay like, $1, $2 over parity, because that you could just buy the stock, right? Or do some other option to offset it. So you got to watch those, you got to, once you get to that, period, then you got to see it. Can I close it out at can I close it out at parity? Or, or can I maybe buy a different option against it at parity? Or if not, you might just buy the stock. And if you buy the stock and you get assigned on your short, they're going to offset each other. All right. If you don't do that, then you're coming in Monday with the position, short stock, and then you have that delta risk, right? You have that directional risk. It could go either way. So that's one way you need to manage that risk, your assignment risk. I think it came because somebody said, how do you repair a position? This isn't really repairing it. This is managing your assignment risk, because then you have this risk on the table. But let's say the stock finishes a little bit below. So even if it finishes a little bit below, let's say 395.90, the stock can still trade after hours, right? You could trade, and I think you have the other side has until like 5 o'clock. They're always changing the rules, but until 5 o'clock to exercise. So the person who owns those options, even if they don't get automatically exercise, so the OCC automatically exercises any option that's in the money. But if it's not in the money, that person still, the owner, has the option to exercise it, even if it's not automatic by the OCC, right? That's part of the contract. And if the stock floats above 396 at after hours, well, he'll just say, hey, the stock's already above 396. I'm going to exercise my call and sell the stock in after hours above 396, because that would be leaving money off, on the table if you don't do that. So the person on the short side still has that risk after hours, because if that happens, even though the stock closed below the strike, if it's trading above there, you still have that risk that you might get assigned, because the person on the other side still has the option to say, I want to exercise my call. Okay. It's important to understand that. That's why at expiration, you want to look at your positions and manage that risk if you don't want it on there. So you might want to close out of that call anyway. So even if the stock is 395, 90, 395, even if it's close to that strike, you may want to close out of it if you want to take that assignment risk off the table. Okay. On the other hand, let's say you're long the 396 strike, right? Let's say you're long the 396 strike, and the stock closed at 396.10, right? Well, that's an automatic exercise. So all of a sudden, that if I'm long the 396 strike, the OCC at expiration is going to say, okay, the stock closed at 396.10, the 396 call gets exercised, gets converted to stock. But what if there's news and all of a sudden the stock is down $2? Well, you also have the option to say, do not exercise. So the person on the other side might think they're going to get assigned at 396.10. They might not, because you could say, hey, you know what? I have an option to not exercise. at expiration. Say, do not exercise. I don't want it. I don't want to take delivery on the stock. Right. So even the person on the other side thinking that I'm going to take delivery might end up not taking delivery if something happened and the person enters in a do not exercise. So these are important things to know when the stocks are trading near your strikes that you might want to close out if you want to avoid the assignment risk and exercise risk. You need to manage that at expiration. Okay. Obviously, if the stock is way in the money or way out of the money, then you might not. Then it might be all right. The closer it is, the closer the stock is to that strike, the more risk you have of that assignment. Right. So you do want to manage. You do want to manage that risk at expiration. So the other question was, well, how does at expiration, the OCC, it's very simple. At the official closing price, if the option's in the money, gets exercised. If it's not, it doesn't. Right. And that's all the options. That applies to all the options. But you can exercise an option prior to expiration. These are American style options, and prior to expiration, you could exercise a call or put. And there are certain periods where it is economically advantageous to do that. Okay, there are certain times where that it makes sense to exercise an option prior to it expire. And it's usually around a corporate action or it's because of interest rates. One is, for example, a dividend. And when you have an option, let's just say, I'm going to go to here where we're projecting a dividend in SPY. So when you have an option, you could see here there's a lot of open interest here. That's very deep in the money, right? Very deep in the money. Like, see, as I'm going lower, there are people who own these options that are very deep in the money. Let's just do this one, $150, right? 150 strike. So this is already in SPY down 62%, right? From here. So this option behaves just like a stock. In other words, if SPY goes up $1, this option will go up $1. If SPY goes down $1, this option will go down $1. So, there's no time premium in it. It starts to behave just like the stock does. And it's very deep in the money, unlikely to ever cross, the 150. So if a stock goes ex-dividend, the shareholders are entitled to that dividend, right? So if you own the stock before X date and you hold it over the X date, you're going to get a dividend. If you own an option, you don't get a dividend. Okay, so an option holder is not a shareholder in a stock. So you're going to be out the dividend. So the person who owns the stock gets a dividend. The person who owns the option does not get the dividend. So basically, you're out the dividend. Your risk is the same as the person who owns the stock, right? So you have the same risk on, but you're not, one is going to get the dividend, one is not. So what do? Well, you have to exercise your call and convert it to stock to receive the dividend, right? So that would be before expiration, right? Like, because if you wait till expiration and expiration's after the X date, you're not going to get it. That means you need to exercise that call prior. Let's say you have a March 24, right? So March 24 expirations after March 17th, right? Or whenever this dividend is. Next dividend is March 17th. So you can see here there's open interest, in the 250, 300 call, and so forth. So all these become economically advantageous to exercise the call and get the dividend, because the dividend is like, $1.40 or something, right? So why would you give up $1.40? Because that option is just going to behave like the stock anyway. If SPY is down $10, your option is going to be down $10. If SPY is up $10, it's going to but why would you give up the extra $1.40 dividend? So you want to exercise it. But some people might not. Some people might not exercise it. They're going to forget. They're going to end up still having it. And on the other side, there are people who are shorted. So if somebody is long 22 options, somebody's shorted. So when you exercise it, right, that means somebody needs to get assigned. And the question is, well, how does the OCC decide who to assign it? So let's say there's 22 different individuals, owning each option, right? There's 22 that own it, 22 people that are short the option. And if somebody exercises it, how does the OCC decide, well, who gets assigned? Because that means one person gets assigned and 21 people do not, right? So how does the OCC decide who's the person who takes delivery? They're the ones that decide. It's not like they call the other side and say who wants to deliver. So the way they do it now is through some random process. That's how they do. They might be changing those over time. They have the ability to change it, first out, I don't know if they will, but right now I believe it's just a random process of somebody getting assigned. So that
was excellent, D. Rob's asking me to ask, what happens on calendar spreads of the same strike? Can you ask Dimitri to explain?
Yeah, so even in a calendar spread, right, you're gonna let's set one up. So I'm gonna do March. So I'm gonna do same strike, right? So March. Let's do 399, March 17th, and April 21, 399. So let's see what we have here. Two options on the same strike, right? March 17th on the 399 strike, and April 21st on the 399 strike. So we know that on March 17th, one of these options will expire, right? The other one will not. So that's when you have to make a decision, right? What do you want to do? That first expiration, that's it. Like that option after March 17th will not exist. It's either going to be worthless and go away, or it's going to get converted to stock. So what happens here? If the stock is under $399, right? Let's say it's 390. Well, then this March 17th call is going to expire worthless, and you'll still have one option remaining, the April 21st, 399. It's up to you if you want to close out of it, hold on to it, but that's what's going to happen. But, then that's your position. Or the stock's going to be in the money. Let's say this stock is $405. Well, if you don't close out of both of those options, what will happen is this call, right? You're going to get assigned this stock, and you're going to come in with the 399 call. You're going to be long the 399 call and short 100 shares of stock. So synthetically, you're going to be long a put. It's going to look like this. You're going to be short 100 shares of stock. If assuming that this is above this strike at expiration, this option will go away. So the 399 call will go away. Let's get rid of that. And let's see what it looks like. calculate. So it's like long synthetic put, right? That's your risk profile, because you're long the call, right? So you're long the call. So at some point, the call kicks in, and it offsets the 100 shares. But if the stock collapses, you're short 100 shares, right? So at some point, this 399 call, you can lose all of its pair, you can lose that time premium. But if the stock keeps going down, 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 this 100 shares that you're short will continue to make money. So the call, you could lose the whatever premium in it, but the stock will continue to make money on the way down. So it looks like a synthetic put. Okay, that's if you do nothing and it's in the money. If it's not in the money, right? If it's out of the money, then you're just going to come in. The other one will expire. You're not going to have any shares of this, 0. And you're just going to be long the call. So at March, that first expiration, that's when you have to look at it and decide, what do I want to do? Do I even want to, wherever it is, do I want to close out of it, move on, but on that first expiration, that strategy will stop to exist as a calendar spread. That's it. The calendar spread will be over at that point. And then you got to decide to do, what do you want to do with the residual position?
Well, that was great, D. Answered
Okay.
a lot of questions, and actually, there was a recommendation that you create a book, Dimitripedia.
Well, thanks, guys.
They feel like they get so much information. You really are helpful to this community. It's much appreciated, Dimitri.
Thank you. I appreciate that. Thanks, guys. Well, thank you for tuning in, and I guess we're right up at the end of the half hour. So if there are no questions, let everybody go at this point.
Yeah, I think we're good. You have a great weekend, my friend, and a great trading day, everybody. Thanks so much again, Dimitri. Awesome show.
Thanks,
Bye-bye.
everyone. Have a great trading day. Stay safe out there. Have a great weekend. Hope to see you guys on Monday.